Chamath, would you have paused and waited to see another card and then watch the hand developed? Or do you think they're doing the right thing by raising, or should they have cut?
I think they did the worst thing possible, which is they took the middle path. If you think about what the Fed has the ability to do, they obviously have the ability to raise and lower interest rates. But what we don't talk about is they have a balance sheet that can absorb assets. For the last 10 or 15 years, we've had a phenomenon called quantitative easing. And for folks that don't understand what that means, that is essentially the Federal Reserve buying assets out of the market and giving people money for it so that people can then go and buy other things with that money. Last June, they started what's called quantitative tightening, which is essentially reversing that policy and restricting the liquidity in the system. So if you look at those tools and you sort of play a game tree on what the Fed could have done, I think that you have two choices. One is you massively let inflation run amok, where you have no tools to fix, or you have massive illiquidity in the financial system, but you actually do have tools to fix that, which is through some combination of quantitative easing and tightening, depending on how much liquidity you want in the system. So I think actually I disagree with Sachs. I think they should have done the opposite. They should have raised 50 bips. It would have created a little bit more chaos in the short term, but it would have set us up to understand what was fundamentally broken and still give the Federal Reserve the ability to use their balance sheet and use liquidity in the future to solve the problem. They took the worst option, which is neither did they cut, nor did they raise enough. And so this problem that Sachs represents actually is the fundamental problem now, which is you won't have enough clarity and signal to really know whether this 25 basis point enough. Look, I've maintained now for 9 months that rates are going to be higher than we like and longer than we want. And so I think it's high time that we acknowledge that we have a sticky inflation problem whose back we have to break. We've known since Volcker era what we need to do that, which is you need to get interest rates to be greater than terminal inflation, which means that a 5% Fed funds rate is insufficient. So we're going to need to see a print of 5.5%, 5.75%. And that's when you're going to have enough contraction. And then the Fed can come back with liquidity. But if they don't take these steps, we're going to be in this very choppy, neither here, neither there situation. And I think that is what causes the real damage, because it's the corrosive effects of uncertainty and what that does to lending, to risk taking. And that I think is really bad for the economy.